Right. I get the message that you all are hearing me, and this program that you all are going to follow, that is economics of monetary policy and financial markets, is one of the modern, if not more applicable in terms of not only the knowledge that you will gain for your program and the course related examinations and all, but also from a perspective that this would help you all to have much more broader perspective in looking at financial markets, as well as the monetary aspects of how the financial markets and economics operate. And you have already kind of covered some of this material through your micro and macroeconomics programs. So I believe you would not necessarily see that areas that we are going to cover in these discussions would be different from your micro and macroeconomics in terms of deriving certain aspects or the foundations in discussions. But broadly, what you are simply seeing here is that the program itself, the course itself, would be much more applicable in terms of not only the knowledge that you are gaining for the examination, but also for the purposes of your own well-being in terms of financial assets that you are coming across, and also from the perspective of what you are seeing in terms of monetary aspects or the monetary economics or the monetary policy that central banks carried out. So from a very broader perspective, I've been repeatedly mentioned by the IBSL that the course pass rate is quite high in comparison to most of the other programs. On average, you see about 75% like pass rate in this program. So I will take you through most of these areas as we move on, but please feel free to stop me by clarifications if you have anything. But from the perspective of what you are trying to understand here is, you will get handouts before all the classes. You will see the handouts being shared. You have to kind of more or less follow these handouts in your lessons. And also there are a few textbooks I will refer in the discussion, but more than the textbooks, if you can follow the discussions and then of course familiar with the areas that we are discussing in line with financial market and financial press, you will be able to have much more clarity in your course related assignments and course related understanding of this program. So let's get into the slides that we have already shared with you all. But what I'm simply suggesting is if you all are taking further printouts or sharing these presentations, you probably access the presentation that I'm using now, and I will ask IBSL to have this one available for you all to follow up. So in that sense, what I'm simply seeing here is I'm just taking the presentation that you are having here. I would appreciate if you can have the presentation also viewed in the form of the notes also available, because I have marked details for your easy reference, assuming that the first 2-3 lectures would not be able to have direct discussion with the participants, but from a perspective of having you all access and then gaining knowledge. But seems things have changed, things have improved. So you are now seeing the slide with some description as notes behind or the below the screen. But if you see full screen mode, you probably not see, but you can follow me very seriously and you can get this access. So this being said, what I'm simply highlighting here is for you all to see anything, you all can follow up and ask any clarification. You can stop me as I move on with the discussion, and we'll be able to discuss and clarify. I believe it's very clear. And you have anything you wanted to clarify before I take you through the slides for your understanding? Okay, so I believe you all are reasonably happy with the arrangements I discussed just now. So the program, Economics of Monetary Policy and Financial Markets, this course would basically highlight or empower you all with critical tools that requires to analyze financial market developments with an economic rationality. When I say economic rationality, what I mean here is that you have basic economic foundation that you all have already studied, learned under micro and macroeconomics. So this would help you to great extent get your basic ideas in economics being employed or applied in monetary and financial market analysis that we are going to do here. So here the program would basically discuss your understanding of these macroeconomics concepts into financial markets and to some extent monetary policy application. Okay, but when I say application, you should not worry that we are not getting into a deeper end of monetary or financial market application. For that matter, I would be saying that you would not be basically computing, calculating, arriving at different analysis. No, I would not get into that aspects of this program. I will leave it anybody who are interested in following deeper postgraduate level studies in a program like this with such knowledge. But we would touch upon foundation, intermediate level aspects of financial markets and monetary policy. So this is broadly the levels that we are trying to understand from this course. And also you may enjoy this program to develop your own analytical skills. When you hear something of financial assets, bonds, bills, when you say equities, that's the stock market. When you say other prices of financial assets, right, mortgages, and also when you see central banks, interest rates, central bank policy directions, you will be able to analyze them on your own rather than kind of, trying to figure it out these things from a different perspective. Yes, you can do your own analysis, and also you can use this in a relative sense in your own welfare, in the sense that for your own profit maximizing opportunities, and also to measure these things into your day-to-day activities you might be engaging going forward, and also to a great extent the welfare of the society. So the financial markets and financial economics, for that matter, would be the core of modern societies in terms of their welfare and their growth. So you may also understand in this program how central banks, monetary authorities, they function and its linkage to the aggregate economic activities. Why the central bank act upon in some direction, you will see from next slide, right? So why they are acting like this, and why markets respond to central bank's action differently. So all would be kind of, felt across in this program, but from a very simplistic approach. So first and foremost, I welcome you all to the course on that basis, and all the very best for your learning interesting topics in financial markets and monetary policy. So this being said, we can move to the next slide, where you are simply seeing an overview. What you are simply seeing here is a news item that you might hear. A news item you might hear in evening news, business news, or for that matter, the financial press. So if you see an announcement by Federal Reserve is the central bank of United States of America. For that matter, you take Central Bank of Sri Lanka, and the news highlights that they have reduced the policy interest rate. So in the case of Federal Reserve, US Central Bank, they call it federal fund rate. In the case of Sri Lanka, you probably hear overnight deposit rate and overnight lending rate. So these are the policy interest rates. So they reduce these rates by, let's say, 25 basis points. That means a quarter percentage point. 1 percentage point has 100 basis points, and quarter percentage point is 25 basis points. So they have reduced the policy interest rates by quarter percentage point. So what you are simply seeing is an interest rate reduction by a central bank. So how this would affect the interest rates on motor vehicle loans that market is accessing, right? So markets are very much popular with motor vehicle loans. Similarly, you probably say housing loans, consumer loans, the financial intermediaries, mainly the banks, they lend these things to the customers. So what the impact this monetary policy or the central bank's policy announcement, reduction of policy interest rates have on these loans? Okay, so would that impact a purchase of a new motor car by you, or a personal loan that you wanted to have it? Would you go ahead with that loan, or you probably decide otherwise to postpone or to see your loan access in the future line? Okay, so whether this decision by the central bank has any impact on housing market in the country, or whether the housing market prices would increase in the future. These are the kind of aspects that when the central bank make a policy decision, the market participants, economic stakeholders in any economy would look upon. Okay, so at the same time, you might think, what would happen to my job prospects next year? The central bank's decision would have impact on investments by stakeholders, and ultimately how these stakeholders would respond in terms of availing jobs for you all, whether you will get new jobs in the future or whether you will not have jobs in the future. So all possible. Okay, so in this particular course that we are studying, okay, this fact is the subject matter, provide a lot of answers to the question that I have now raised. Okay, so these questions would invariably examine how financial markets, when I say financial market, we will get into those explanation in greater details. So what you are simply seeing is a bond market, stock market, foreign exchange market. These are the parts and parcels of financial markets. And at the same time, financial institutions. These are financial intermediaries, the banks, insurance companies. When you say mutual funds, it is very much similar to unit trust in Sri Lanka, but you don't see much popularity in unit trusts, but mainly the banks. Okay, this financial institution, how they work with this type of a policy decision, what impact they will have on this policy decision. So we explore this type of questions in this program. So ultimately, you would also look at what the role of money you have in your pockets, you have in your savings. This is all kind of, assets, and money is an asset, but at the same time, you see the money has a lot of very unique kind of features in terms of how it influences the behavior of other assets in an economy, like bonds I was referring. So we would look at these things as we move on. So you will see financial markets and institutions not only affect your everyday life. Yes, you see when they make decisions that impact your life, when they increase the interest rates that impact your saving interest receipts. And at the same time, if you are a borrower, of course, that is costly because they have increased the interest rates. But when you see the central bank has reduced interest rates, how that would affect the interest rates across the market. Okay, so this invariably contributes to significant flows of funds. You may call it in trillions of dollars throughout the economies of different countries or different continents, which in turn affect business profits, production of goods and services, and also the economic well-being of countries. If anything happens in terms of what's the interest rates and the decisions of leading central banks in the world, yes, that impacts Sri Lanka, that impacts Vietnam, that impacts other countries in Europe, right? So these spillovers are very much there. So you probably see these things. We are trying to answer these things by learning financial markets and economics of monetary policy through this program. So in a similar line, when I was explaining these things to you, you probably see in recent times, Central Bank of Sri Lanka, especially during this COVID-19 pandemic period, have made number of policy decisions. Okay, so they have cut policy interest rates. Cut means they have reduced policy interest rates. They have reduced the statutory reserve ratio. You call it the statutory reserve ratio is nothing but the percentage of deposits that they have to keep with the central bank. So it is 5%. So when the banks get 100 rupees of deposits, of that 100 rupees, 5 rupees they have to keep with the central bank. That is a statutory reserve requirement. Okay, so this statutory reserve requirement, the central banks would reduce at times of market stress or requirements of monetary policy. So they have adjusted these things recently. And also they have made decisions in terms of maximum interest rate applicable for certain type of loans. You can't charge more than X%, let's say 12%. That's the maximum for a certain type of loans banks extend. Okay, and at the same time they have extended moratoriums. Moratoriums means temporary halt of paying of interest or capital of a borrower for a given duration. Let's say for 6 months or 1 year, you have your liabilities of paying your loans back to the bank. So that's been kept on hold. So this is one possibility. Okay, so these were the measures that the Central Bank of Sri Lanka has taken during this COVID-19 pandemic period. These are not all the measures, some of the measures Central Bank has taken. How this would impact the economy, okay? How this changed the health of these institutions concerned, very much the banks and the businesses for that matter. How these decisions will impact their future direction of economic activities. So focus of this program that we are now trying to learn is to explain the economic rationale for above policy decisions by these central banks and how these impact to the financial markets and the monetary policy direction. So this is the focus that we are trying to reach. And I believe you probably get a kind of a sense already by looking into these things. But feel free to stop me, and if you have any questions, any explanation or any clarification that you might wanted to see from this type of discussion. So if you move on to the next slide, what you are simply seeing here is what we will look at in terms of how we move on with this program. Okay, this program would try to examine how financial markets, as I already said, bond, stock, foreign exchange markets work, right? How these markets work would be a key focus for some of our discussions. Also, we would try to examine how financial institutions, mainly the banks, investment and insurance companies work. So what their intentions, how they try to kind of look at and how they try to maximize their opportunities in the financial markets, or for that matter in the economy as a whole. Okay, so as I said again, we would look at role of money in the economy. There's a big role for the money to play, and that's why the central bank come into the picture, and they have a big role in terms of driving the economic activities at any given time. And also you would try and understand how central banks set about their business. Central bank has vested responsibilities in terms of the relevant laws under which central bank has been established, right? In the case of Sri Lanka, it's the Monetary Law Act, right? So they have given certain responsibilities. How they are set about this type of objectives in their discussion. So that's another focus. And also we would look at other greater macroeconomic developments, but I usually see the aspects of macroeconomic developments. In most cases, I do not get opportunity to get into that few lessons towards latter part of the program due to time constraints, but we generally see that we cover most of the other areas in our discussions. So for your understanding, the textbook often I refer in discussions is The Economics of Money, Banking and Financial Markets. The Economics of Money, Banking and Financial Markets by Frederick S. Mishkin. So this book is available in the IBSL library and leading bookstores. I generally prefer 10th edition or latest editions, no problem. But any edition after 6th edition is all right. And for your information, I also have seen online access for unauthorized copies also available. You can search Google or whatever, and you can see some of these materials in general use. But you have to more or less follow most of these things in terms of regular discussion in the classroom. And you probably see, if you have a habit of following financial news in Sri Lanka, because in Sri Lanka now you get a reasonably good quality financial newspapers and also at times media discussions. So you can have these access, and you probably be able to get some of these areas that we are discussing in the class being again discussed and elaborated through these sources. And also you can on your own search materials from different online possibilities. So these would help you. But mostly if you follow the more or less the lectures and follow the kind of presentations that we are share, and try to apply some of those stuff with materials that you see in media, that would be much more sufficient in terms of your preparation for the exams, and also to great extent you get some feed onto your own welfare. So if you have access, please refer these textbooks. That would help you to kind of get little more understanding in terms of how you wanted to go on with the studies in this program. Any questions that you have? Right. So we will move on. We will have the discussion in terms of the financial markets. So we are continuing to introduce into the course that we are going to learn. So why we study financial markets? That's a very good question that anybody would ask. Okay. So it is very important that financial market, as I already said, bond and stock markets in greater sense are very, very important or crucial in any economy. And especially for a country like Sri Lanka, it's very, very important, right? So these markets, these financial markets that we are referring, they channel funds, right? So some parties or stakeholders in the economy, they are savers. They have excess over and above their needs. So they save part of their income or assets that they have. And these savers kind of, channel their funds, okay, to investors. Investors are often again these savers in one sense, but at the same time, investors could be the ones they are borrowing resources from financial intermediaries in this financial market or through financial assets in the financial market to promote economic efficiency. So economies has to move on. They have to expand. They have to invest in new ventures. So for that, they need resources. You can't have all the resources on your own. If you want to have that, probably you have to work all life until you get retirement. Probably then you save a reasonable amount of resource. But when you wanted to go and start a business, probably you are too late and you would not have strength to carry out a business. But you can invest that money. So the markets would pool this money. But when you have a good business idea when you are young, so you can now go to the financial market and get these funds from savers. They would be ready to kind of share part of their saving for your investments, either directly or indirectly through financial intermediaries. So financial markets channel funds from savers to investors, thereby promote economic efficiency. And at the same time, the market, financial market activities affect your personal wealth. Okay, so markets are there in terms of prices. So when the prices change, that affects your wealth. Either you become rich or part of your wealth get reduced because prices in the market get adjusted, right? So then the behavior of firms, that also impact to great extent because of the market activities, and ultimately economy as a whole. So when you see these financial market aspects, right, so you ultimately kind of push to a point where you require these markets in terms of your economy's health. And it's very crucial in today's context because most of the countries operate in terms of resource constraints. So they want resources to expand their economies and to achieve their full potential. So you see these possibilities. So from a different perspective, if you try to define the financial markets, this is also the marketplace, right? So this is a market in which funds are transferred from people and firms who have an excess, as I said, savers in that sense, of available funds to people and firms who have need of funds. As I said, it's the borrowers. So the financial market is a place through which you should not necessarily think when I say a place, a physical location, but there are famous physical locations that's how identified in terms of financial markets. The Wall Street, the best example that you are listening, the London, Frankfurt, right? To some extent, financial centers in Middle East like Dubai, okay, Mauritius in the East Africa. Okay, so then of course, East Asia, you see number of financial centers coming up. Singapore is one. So, okay, so you see even in Sri Lanka to some extent, you could see Echelon Square, where the World Trade Center and most of the financial institutions, including the central bank, is located. So you see, this is kind of a place to great extent, but not necessarily physically defining a place. Okay, in this place, the financial assets get exchanged. So this is a financial market. Okay, so this is not different to goods and services markets that you are familiar with. The financial market meet buyers and sellers of financial products, for that matter, who processes excess resources and who are search of such resources to carry out their economic activity. So this is a broader kind of direction and a definition for you to understand what is a financial market. Similarly, if you look at these financial market, you probably see these markets are well functioning. Okay, when I say well functioning, these markets like bonds, stocks, and foreign exchange market, right? So would kind of promote economic efficiency, as said, okay, and also a key elements involved in producing high economic activities or the economic growth for that matter, because well functioning financial markets are a definite plus for a economy in terms of achieving its growth prospects, because that channel resources from excess entities to shortage entities much more effectively than you probably think kind of other type of financial transactions, if not barter kind of trades that existed in the past. So efficient financial markets are characterized with high economic growth most of the time. So we will briefly examine each of these bond, stock, and foreign exchange markets, but you've probably seen that you probably covered some of these aspects in your previous discussions in other programs. So that would be helpful, but we will touch upon briefly in our discussions and some elements of statistics and how we will examine them throughout this program in terms of different aspects of study. Okay, so you probably see these notes also explains you with more or less the details in terms of the financial markets that you are trying to study. As I said, the financial markets characterized by a price which comes with efficient market functioning. We will come to the point where the price determination, how this price being determined through a supply and demand process that you have already familiar with from your macroeconomics or microeconomic studies. Okay, the market cleared price is the equilibrium price that you used to, right? So in the financial markets also, supply and demand for financial products will determine what is the market price for financial assets. This is no different to market for orange, pineapples, or for that matter, your favorite haircut. But probably these days you all might not have opportunities to go for haircuts because of the COVID environment. But anyway, I mean, it's a price. Supply and demand would determine this market clearing price. So in the financial markets, the price determination is much more organized, structured, and involve processes and characteristics to recognize them as well functioning. Okay, we will learn these aspects as we move on. Any questions? So you can clarify if you want anything as we move on, but I will take you through. Similarly, I mean, when you say debt markets, you probably kind of, see another very important aspect in debt markets. You can't take or separate out so-called interest rates considerations or interest rates concepts when it comes to debt markets. Okay, mainly when you say debt markets, you naturally think of bond markets. Okay, so in the bond markets, the governments and corporates and individuals borrow to finance their activities. So there are characteristics of these bond markets. We would be able to discuss them in greater details as we move on. Okay, in this bond market, the borrowers issue a security. Okay, so bond is a security with certain characteristics. Okay, so this security is called a bond. Okay, so what that bond is the promising that this issuer would timely pay the interest as determined through a process and the principal, that is the capital, right, over some specific time over the period. So this bond is a kind of a promise of timely payment of interest and principal over a period of time defined through the financial market arrangement. So this is one of the markets that you are very familiar with. Okay, so when it comes to the cost of this borrowing, it is nothing but the interest rate. Okay, so interest rate is the cost of borrowing that you are seeing. But you probably see these interest rates would be defined through different jargons, names in the financial markets. In the case of bonds, you often familiar with the coupon payments. So you will come across these things. We will get into those stuff in greater details as we move on. Okay, so these markets, or debt markets for that matter, facilitate resource constraints of agencies based on its credit quality to create a liability in the form of borrowing. So what I simply trying to say here is the markets facilitates constraints of businesses in terms of accessing finances based on their credit quality. So if you are a high credit worthy individual, you would have easy access to most of the financial intermediaries for borrowing. If somebody who is very low in credit quality, you would have difficulties in access to finances from the financial market. So your cost of financing would be very high. Okay, so-called this credit quality concept, we also would discuss through credit rating process. You see, there's a complete arrangement in terms of credit rating by leading credit rating agencies in the world. Okay, there's a process involved, and how they define these credit ratings across different credit qualities, we would be taking through in one of our discussions going forward. So you would be able to kind of get those knowledge in terms of where you wanted to see in terms of a business or a institution and what's their credit quality from a very easy, understandable single letter word. One would say B plus, one would say double B plus. So when you hear that, you know the credit quality of that institutions, right? So it's a credit rating process. So we would kind of, get into those stuff as we move on in this program. Okay, so this debt market borrowing invariably is a promise based on credit quality, and the issuer or the borrower for that matter, he promised that he would honor his obligation periodically, and the principal or the face value of borrowing at maturity. Maturity is the time of completion of the contract. So if it is a 10-year bond, the 10th year is the maturity period, maturity year. So there would be a date on which the maturity falls. On that day, this bond is matured. So you will get the face value, if not the principal. So this is kind of, the process that you would see, and we would kind of, get into very specific concepts in this process as we move on. Okay, any questions? Right. So you see this process as we move on, and also market interest rates. When you say interest rates in terms of debt market, as I said, there are many different types of market interest rates. So you might see mortgage rates, somebody say loan rates, somebody say credit card rates. There are various type of interest rates. Now, for instance, in Sri Lanka, somebody will say senior citizens saving deposit rates, okay, lending rates, then prime lending rate, coal money rates. There are a number of different types of these interest rates available. So you would see these aspects, okay, but these interest rates are not necessarily same across different time periods, okay. So the levels like height of these interest rates are very important for us, right? So from a different perspective, in US, I've just taken US example in terms of mortgage rates, okay? In early 1980s, the mortgage interest rates were double-digit numbers. It's about 13–14%, okay? But in recent years, it's about 3.5–4, but now it's lesser. It's lower than 3.5 levels now. So what you're simply seeing is the levels at different time periods changes, right? So there's some element of taking out these changes in terms of a concept called nominal interest rates and real interest rates. We would look into those concepts as also a part of this program, okay? And also the same financial instrument that you are looking at, for instance, even a bond last month to today, or last year to today, 10 years ago to today, the interest rates are different. Why these interest rates differ, how these interest rates changes, is also a focus of this program. We will get into those stuff as we move on in our discussions. Right. So some elements of concepts that we discussed as you look at a debt market, particularly the bond market and interest rates, as we were discussing, by a security, which is a financial instrument. A security, a bond is a security, financial security, it's a financial instrument, okay? So what it embodies is a claim on the issuer. Issuer is, let's say, government of Sri Lanka, or for that matter, a corporate, okay, or a bank, right? So it's a claim. This security is a claim on the issuer's future income or assets. So that's what they promise you to pay in terms of periodic interest, that is coupon in the case of bonds, and principal, that is face value at maturity. Okay, so it's a claim by the investor on the issuer's future income and assets, right? So when I say a bond, now you should be able to kind of recognize the bond as a debt security. This debt security promises to make payments periodically for a specified period of time. When I say specified period of time, you probably see 5-year bond, 10-year bond, 20-year bond. So that specified period is 5-year, 10-year, 20-year. So that's what it basically says. And it makes payments periodically. Some bonds pay 6 monthly, semi-annual coupon payments. Semi-annual is 6 monthly. Some bonds pay 3 monthly coupons. That means 4 interest payments per year. But semi-annual is 6 monthly. That is the most common way of making payments for treasury bond interests. Okay, so this period, this specified period that we were referring, either 5, 10, 20, that's number of years, the lifetime of a bond. Okay, so as we defined already, interest rate is the cost of borrowing or the price paid for the rental of funds. So it's like you rent your house, so you get a rent income. Similarly, you rent your funds by investing in a bond. So you rent your funds to an institution. So it's an investment. Okay, for that you get a return. That's the interest rate. So the interest rate for you is a return. At the same time, for the borrower or the issuer in this case, in the case of bond, is the cost of borrowing. How much he pays for the bond investor is his cost. Right? So you probably see these in greater details as we move on. And quite familiar bond market instrument is the treasury bond that's issued by the government, sovereign governments of many countries, including Sri Lanka, where you're probably familiar with treasury bonds. Okay, and as you already know, as you rent a house and get a rent income, okay, when you rent money, that's a bond investment, as I was mentioning, you receive the interest income as the return. So these names used for returns vary across different financial assets. That's why I said when you look at a bond, the interest receipts that you are receiving periodically is the coupon payments by the issuer, the coupon receipts, right? So it differs from one financial asset to other. So as you kind of learn this program, you will get hold of these concepts as well. So it's not hard, not difficult. So it's something that you have to interestingly look into. So that's why I said when you study this program, you should be able to kind of, get used to refer to financial press, get used to listen to financial market and monetary policy discussions, right? And also get used to kind of, read through web pages of financial assets and financial markets. That makes you understand these concepts much more clearly, right? When you analyze these things and when you see the next slide, you see a time series interest rates behavior of selected bonds in the US market for a longer duration, more than 60 years. So you can see here 3 different type of interest rates. 2 of them are US government related treasury bonds and US government, US treasury bonds and US government's 3 months treasury bills. Okay, 3 months treasury bill is usually the shortest maturity financial instruments most of the times the countries issue. Even in the case of Sri Lanka, 3 months or 91-day treasury bill is the shortest maturity government security. The US government long-term bonds could be 10-year or longer. And then you see corporate bonds, corporate BAA bonds. BAA is the credit rating. So I said that measures the credit quality. So by saying BAA, there's a kind of a feeling immediately comes to you in terms of this particular corporate's credit quality. But for the time being, you might not necessarily know, not necessarily aware of what is this BAA is, but you would learn when the credit rating sections being covered. So it's a kind of reasonably high credit quality, a corporate bond. But still, you can see the corporate bond yield rates, or for that matter, interest rate in this case, right, is higher than the US Treasury bills and US long-term bonds. So that carries out a kind of, risk description in terms of risk return characteristics. So if you see a risk in terms of your investment, you probably want a higher return for such investments than investment which is less risky or no risk at all. So usually when you say government papers or government bonds or government bills, which are less in risk simply because government can tax people or print money. Okay, corporates also can tax people by increasing prices, but then of course you have the option either to buy or not. But when the government's tax, the chances that you cannot keep away from such is limited. So you get hold of either indirectly or directly through these tax processes. So there's a kind of understanding in any financial markets. The government papers are the lowest risk. So if not, they call it risk-free financial assets, whereas corporates or other issuers like businesses, they have higher risk in terms of the assets that they sell in the financial markets. So then they have to pay a higher return than the governments in this case. So US government pays lower in terms of 3 months bills than long-term bonds. Then that element of time duration also come into play. So what you have to understand here is from this chart, the behavior of these interest rates is linked with risk and return characteristics. So from a very simple explanation, what you have to understand is if the risk is higher, return, if not interest rate, also has to be higher. If the risk is lower, you have to understand the explanation here is the return or the interest rate applicable for that financial asset is also lower. So today you learn a very important lesson, and please remember, even after the discussion, if you start kind of, memorizing, try to kind of get hold of this concept while walking for each steps that you are keeping after this lecture, just say to yourself, higher the risk, higher the return, lower the risk, lower the return. So please mimic this as long as you get the concept into your head. That's very, very important. This is a basic foundation that you will always repeat in this program. So this time series behavior of yield rates that you are seeing here also explains that in terms of risk and return characteristics. Please understand another aspects of this chart that I'm explaining here. This is not a yield curve. This is a time series behavior of interest rates of financial assets. If you want to have a yield curve, what you'll probably be drawing is, okay, you can draw a vertical line across, let's say, 1995, as I explained in the notes to this slide. So you can draw a line, vertical line, and then look at those points. Okay, so you may take 1995 as example. Okay, so 3-month bill rate is the lowest, and then you see corporate BAA rated bond yields are the highest of this 1995 point, the vertical line that you have drawn across this chart. So what you are simply seeing is 3-month bill is the lowest, corporate bond yields are the highest. In between, you could see the long-term US Treasury or the US government bonds. Okay, so that's a point of important point that you are trying to learn from this chart again. The yield curve versus time series behavior of yields of financial assets. So sometimes I also have seen so-called financial pundits, they come out in financial press or in media and try to explain these things as yield curves. It's not the case. This is a time series behavior of interest rates or yield rates of financial assets. And if it is a yield curve, at any given moment of time, how similar risk or credit quality assets yield rates differs. Okay, so that's what you probably see in a vertical cross. If you draw across this chart, and you see the 3 months treasury bill interest rates is the lowest. In between, you see the US treasury long-term bonds, and on top the corporate BAA bonds yields. So that shows, right, lower the risk, lower the return. US 3 months treasury, lower the risk, return is lower. The corporate BAA bonds compared to US treasuries, the risk is reasonably high. So then it has to pay the investor a reasonable compensation. So it pays a higher a return or the interest rate compared to US 3 months bill or US long-term bonds. So between US 3 months bonds and US long-term bonds, also you see an interest difference. That interest difference comes from time duration. So 3 months is 3 months, long-term could be 10 or longer. So the longer the time duration to mature, right? So another very important concepts now you are trying to learn. The uncertainties that could happen from 3 months to 10 years, the uncertainties that could happen for 10 years is greater. So the investors request an additional interest payment for that time duration that they are looking at, although US Treasury bills or US long-term bonds are issued by the same issuer, the government of United States of America, basically the US Treasury, right? But still, because of the time duration, you have to pay. You have to pay a higher return. So longer the time duration, you have to pay an additional premium. We call this as time premium. But please remember, these things could turn around based on market perception of what's going to happen in the future or what's the circumstances of the economic condition. So then the other things kind of try to play a role here. But what I was trying to explain is the basic economics that you have learned, so-called ceteris paribus condition, other things constant. So keeping aside other things, okay, lower the return, lower the risk. Okay, higher the return, higher the risk. If you see a financial asset, its risk is high, the return has to be high. If you see a financial asset's risk is low, return has to be low, right? If you see a financial asset's, its duration is longer than another financial assets, there should be some time premium also accommodated, if not added. So these are the elements that you have learned from this chart for your understanding. You probably seen this type of charts in the past, but now you see it from a very different perspective. Okay, any questions? Right. So we can move on. We can move on and we can see the next slide. So this slide also shows government of Sri Lanka's international sovereign bonds yield or the interest rate behavior over a time duration. Let's say 2017 to 2019 like. So what you are simply seeing is ISBs. ISBs is international sovereign bonds of government of Sri Lanka. So there's this time series behavior of different bonds issued by government of Sri Lanka in the international capital market. Okay, so you may see here the interest rates are volatile. As I said, the levels changes across different time period and increasing in recent times. Okay, so when you see this real rates are increasing, invariably it's upward sloping, upward trending in this time series analysis. Okay, so we can discuss these things. You would come across this type of charts and you will be able to kind of, you know, explain what driving these interest rates to increase in recent times, what economic fundamentals, what circumstances would have driven the government of Sri Lanka's international sovereign bond interest rates to increase in the secondary market, right? So you probably see this type of behavior. I'm not necessarily trying to explain why the yields were trending upward in recent times, but towards the latter part of this discussion, if not the program, you yourself will be able to answer to these queries. You will be able to see why these interest rates are driving upward, heading north. These are different jargons or the language you probably hear the financial markets would be using. So this direction is upward trending to great extent, right? So you will be able to see this and you will be able to explain as you kind of, you know, learn this subject. But you will be able to, if you are an investor, you have some resources, or you are an investment advisor, you will be advising your clients in terms of investment possibilities. You can make use of knowledge that you are going to gain from here and advise them accordingly to benefit in terms of possible return opportunities available in the market, right? So on top of looking at its impact to the overall economic efficiency and the economy as a whole, you will be able to see these things. Okay, so this is a very kind of, you know, classic direction in terms of what you are seeing in financial markets and how the financial assets operate and behave. And similarly, you can see so-called stock markets, right? So in the stock market, when you say you are a stock owner, I mean to say a common stock, there are different type of stock definitions. But when you say a common stock owner, what it represents is you are an owner of that corporation or the business. You have some share of ownership in that corporation. So if you have stocks, common stocks, you are basically an owner of that institution. Okay. So ultimately, if you have a stock, what it entails or what it basically says is you have a claim on the residual earnings and assets of that corporation. I mean, when I say residual earnings, after paying out all the liabilities, whatever left with that organization is the owner's assets. They can share that among them, but they don't, normally they don't share everything, residual earnings every financial year. They keep part of that for retained earnings or for other retained profits for different reasons, like to use in difficult time periods. Okay, so for that matter, even a COVID-19 kind of environment, if your corporation is having difficulties in terms of limited market operations, so they can make use of whatever the retained earnings to be distributed across different purposes of the organization, rather than trying to borrow on fresh. Borrowing also difficult when the markets are not necessarily functioning. But it's a kind of, a claim that only the common stockholders have. Everything available can be shared among them after paying out for liabilities, and also all the assets of the corporation is there. They can distribute across. Okay. So what you have to understand is, if you are a stock owner, you are basically an owner in that corporation. You have ownership stake, right? So you also see, when it comes to stock markets, the different stock indices, right? So for that matter, what you are simply seeing here is so-called Dow Jones Industrial Average. This is very famous index in US. This comprises number of industrial related corporation businesses stocks embedded in. It's not a single stocks price behavior graph here. What you are simply seeing is they have pooled different corporations stock prices and then created an index. Usually index has a base here, like CCPI, Colombo Consumer Price Index, equal 100 on a particular year. This index also, sorry, industrial index also has a index value on a base here. Mostly it's 100, or sometimes it may be 1000, but it's 100 in the case of Dow Jones Industrial Average. So then from 100, if you take how these stock prices behaved over a period of time, you probably see it is trending upward. So whoever invested 100 in 1950, probably by 1990, gaining like 30 times return. It's 3000. Okay, and similarly, it has gone to 15,000 by 2006, like then it's crashed. That's due to financial crisis, great financial crisis. We would be studying that also. And then again started kind of, again increasing based on the recovery in US economy and rest of the world. But recently again, because of the COVID, you've probably seen financial markets, stock markets particularly, is crashing across the world, right? So these were the things that you will come across and try to understand after studying this program. You should be able to explain why, what drives this behavior, what impact this has on the wealth of stakeholders, like people. If you are an investor, what happened to your money, income, ultimately what it's to the employees of that corporation, and to the aggregate economy. So these are very, very important yardsticks to measure the health of an economy, health of an investor. So you are basically kind of, moving in a direction where you are pooling your knowledge that you have gained across different programs up to now in your studies, and try to kind of learn something very, very important and unique. Right. Any questions? Okay. So if we move on, you probably see we have looked at financial markets to great extent in terms of more broader financial assets. And I said at the very beginning, maybe the second slide or third slide, okay, the institutions also important in financial markets. So institution in the sense the financial intermediaries, the go between a saver and a borrower, or go between, right, financial product between parties to the financial transactions. So that's a financial intermediary. Okay, but the conservative, if not conventional, function of these financial institutions or the intermediaries is that they borrow funds from people who have saved and make loans to people who wants to borrow. So the intermediaries, when you say financial intermediaries, it's very easy to kind of, remember these are banks, but include other type of financial intermediaries also. Okay, so banks accept deposits and make loans. So this is the conventional conservative function of all the banks in the world. So in addition to that, there are various type of other financial institutions, insurance companies, finance companies. Then you see pension funds, mutual funds. Mutual funds I was mentioning in Sri Lanka, it's the unit trust most of the time, right? So investment houses. These are other financial institutions. So they also play a very similar role to banks in terms of financial market activities, but maybe different to kind of, the operations of banks in terms of certain aspects. We would be getting into those as we move on with the program. Okay, and also the financial innovation is also another very important aspects of financial markets. These innovations are the developments of new financial products and services based on the requirements of the financial markets or the stakeholders, right? The new financial products come into operation. I mean, today, I don't see anybody who does not have a credit card or a debit card for that matter. So look back. About 30 years ago, 25 years ago, the environment is totally different. So these innovations, right? So on top of that, today you see the mortgage products, derivative instruments, right? So various type of financial products comes into play. And on top of that, this financial innovation is also to some extent being considered as a driver, if not magnified, the financial crisis in 2008-9 period because of the complexities of underlying assets involved in these transactions. But what you have to recognize here is, apart from intermediaries, innovation is also part and parcel of financial markets. Okay, and this is an important force for good by making the financial market and the financial system more efficient. And today, with these COVID-19 developments, you see all electronic payments and electronic instruments are getting popular. So that's another direction now the world is focused more. Of course, it carries certain type of risk, and the financial markets are mindful of it. And they are trying to kind of devise ways and means to kind of counter the possible risk and try to design these instruments. Okay. Okay. As I again repeat the concept that I mentioned already, the conventional function of financial intermediary is to accept resources of surplus entities and channel these resources to productive activities of deficit entities. So saving versus lending. That's a conventional financial market activities. But this conventional activity over the years has evolved with financial innovation. And today's context, most profitable banks earn more from not this margin-based. Margin-based means you borrow funds. That means you get the saving funds at a certain cost. Okay, deposit interest rate, let's assume 5%, and you lend at 9%. So 4% is the margin. Okay, so most profitable financial institutions earn more from not these margin-based activities, but fee-based activities in terms of designing financial assets, introducing financial services, act as the custodians, act as lead arrangers, various type of financial services that they perform for financial markets. So financial markets also evolve in recent years and still evolving, and I expect it to evolve in the future too. So thereby it makes efficiency of the financial systems, and thereby overall economic growth and economy's prospects. Right? Any questions? Okay. So you see again, we also look at in this program the financial crisis. 2008-9 is a classic circumstance of financial crisis that the countries across the world has faced with. And then, of course, the recent COVID-19 related also now sets upon difficult times across financial markets, right? So we will be able to kind of, get into these as we move on. But to understanding, but for your understanding, what you have to understand here is the financial crisis are major disruptions in financial markets. Okay, so in such circumstances, the markets are characterized by sharp declines in asset prices and the failures of many financial and non-financial firms. So when you see a financial crisis, you probably see the market prices of financial assets are collapsing. Institutions, for that matter, banks are collapsing. So these are characteristics or the kind of, outcomes you see when the financial crisis is there. Okay. And these financial crises are severe in magnitude with collapse across financial activities and the overall economy. The most recent financial crisis is the global financial crisis, that's in 2008, right? The pain of these crises are immense and markets are often one-sided in such circumstances. When I say one-sided, what you're seeing simply is everybody in the financial market during crisis is in the selling side. So everybody is selling, nobody is buying. So market prices simply crash. So think of you are going to the Sunday market, right? Everybody is selling, nobody is buying. So what happens to the prices? Prices would really come down. So financial assets prices also come down like that at times of financial crisis. And financial markets do not necessarily see activities during such circumstances and stop functioning. You probably see now most of the financial markets are screen based, like electronic trading platforms, like stock markets that you are familiar with. All of a sudden they all close because everybody is selling, nobody is buying. In such circumstances, financial asset prices crashes. Everybody is one-sided. So to create a market, as I said, you need both sellers and buyers. So then only you can come to a equilibrium price, your basic macro and micro economics. So to have a functioning financial market, you need to have buyers and sellers, and the financial assets prices have determined through the interaction of demand and supply in the market. But unfortunately, there is no demand at times of financial crisis. It's all supply, supply in the sense sellers. Okay, so in case of recent pandemic period, yes, globally the financial markets had these difficulties. Even Colombo Stock Exchange in Sri Lanka was closed for a month or so. Only they opened last week, I believe, or the week before. Yeah. But seems the Colombo market has returned to its gradual upward trajectory, but immediately the market really came down and had to close few times because of one-sided selling pressure. So you probably see this type of development across all the markets in the world at financial crisis, but COVID-19 is not yet a financial crisis, as what you probably heard in 2008-9 period. We will get into those stuff in greater details as we move on. Then monetary policy, very, very important aspects of this program, right? So you might have felt it for yourself. There's enough evidence that suggests that money plays an important role in generating business cycles. When I say business cycles, so it's the kind of reasonably long-term behavior of your economic growth or the economy's growth cycle. So if you draw Sri Lanka's growth cycle from 1950 to current years, you probably see it has different shapes going upward, okay? So then you are seeing it's like flattening at a point and then again declines, and then the recovery like bottomed out pace and then again start going up. So gradually the economy is going up from a certain level to the other with these swings across this cycle. During these different time periods of these cycles, the money, the quantum of money available in the economy is very, very important, and it plays an important role in kind of, contributing to kind of shape up these business cycles. Then at the same time, you'll probably see so-called recessions. Recessions are the periods of declines in the sense negative growth. It's not necessarily declines as such, but what you can simply say is minus economic growth cycles. In US, 2 consecutive quarters, one quarter is a 3-month period, 2 consecutive quarters of negative economic growth is considered as a recession. So at times of recession, the unemployment increases, the people loses jobs because businesses run out of business. New economic activity is not being kind of initiated. Expansions in terms of investments become very little or limited. So what happens is even the people who are employed get unemployed during these periods. Okay, and similarly expansions, the periods of growth, economic growth. You see the businesses expand, they initiate new activities, they expand new businesses, they invest more on their projects. So new employment opportunities generate. So even the people who are unemployed get employed during that period of time. So globally, in such circumstances, if you do not have enough human resources available within your the kind of foreshores, that means within your country, you'll probably be able to hire from rest of the world. So it's more or less the good times. So this also a part of the monetary policy discussions and how monetary policy responds to such possibilities in terms of recessions and expansions and related considerations in terms of maintaining stability, economic stability at different time periods. Okay, so the monetary theory, we would not necessarily get into greater details of monetary theory, but we would try to understand the foundations and basic concepts of monetary theory in these discussions. The monetary theory tries to, okay, and it ties down the changes in money supplies to changes in aggregate economic activity. Aggregate economic activities to some extent can be linked up with business cycle, and the price level. Very, very important in monetary policy to look at the price level's behavior. When I say price level, it is nothing but the inflation that we are looking at, right? So almost all the central banks in the world are striving to achieve so-called price stability. And on top of that, they probably be looking at few other objectives to be fulfilled, including economic stability in the case of Sri Lanka and financial system stability. That also part and parcel of Sri Lanka's central bank's objectives. And at the same time, you probably see the central banks like Federal Reserve, that's a US central bank, they would be looking at multiple objectives to be fulfilled. And they wanted to see full employment to a great extent. So to make sure that the economy is operating at its usual capacity. So they would do many things, but between lines, they also wanted to see the price levels or the inflation being maintained at a reasonable level. So this is the focus of most of the central banks in recent times, and central banks have moved into a direction where they are targeting inflation. So inflation targeting concepts being also discussed. So we will try to kind of get into these aspects to some extent in our discussions going forward. Right? Any questions? And similarly, you probably see the aggregate price level, as I said, is the average price of goods and services in an economy. So measured by inflation index that you'll probably be familiar with. Colombo Consumer Price Index, or for that matter, now in Sri Lanka, we have National Consumer Price Index, NCPI, National Consumer Price Index, CCPI, Colombo Consumer Price Index. Okay, so when you see continuous rise in the price level, you call it inflation. Okay, so what it entails there is that impact all the economic players. When the prices, inflation is there, everybody's buying abilities get shrink, right? Unless you see their earning capacity also adjust in line with the increase in price levels, right? So you see this type of development. And also there's a kind of a correlation in terms of money supply and the price level. So it was reasonably positive in early part of, let's say, second half of 19th century, or in fact, 20th century. It's after 1950s, like there's a significant correlation between money supply and price levels. But towards latter part of 1970s, like there's a kind of weak correlation between increasing money supply and price levels, because globally the central banks have started kind of managing their inflations reasonably well. So there are kind of literature in this front for us to kind of discuss. So we would try to kind of learn basic foundational directions of these aspects, and we would not get into greater details as I was mentioning at the very beginning. If somebody wants to do postgraduate level studies, or for that matter PhD level studies, you'll probably be interested in getting into monetary theory in greater details. But we would necessarily see the basic foundational aspects in this program for you to understand exactly how the kind of a role of the money is playing in terms of aggregate economy. So this is the direction that we would be making as we move on in terms of this program. And then you see here some empirical implication in terms of different money growth rates and behavior in terms of US. And you see different money supply compilations, we call it different M numbers. When you see M0 to M2B to M4, what you are basically doing is you are adding up basic monetary money stock with other elements of compilation into the equation. So you can see at different times of growth, followed up with these shaded areas where they've been explained here, right? In US case is the recessions, right? So the shaded areas here is the recessionary periods. I defined in the case of US 2 consecutive negative economic growth quarters being considered as a recessionary period. So you can see a more recent point is the financial crisis time, where you see a recessionary period. But in such circumstances also, US money growth rate was reasonably on the increasing trend, right? But prior to that, what you are simply seeing is after an increase, then the growth is come down and possibly followed by a recessionary point. That was like the period I was mentioning. There's a higher correlation, but in recent times you probably see a lesser correlation in terms of money supply and price levels. This also the kind of empirical direction, but we could be able to detail these out as we move on in our discussions. And then you see here again the aggregate price level I was just mentioning as inflation in our previous discussion, yes, and the money supply. You higher the money supply growth, and you see the aggregate prices also kind of increasing at points, but since recently that has broken down to some extent, but it's not broken down, but its correlation is to some extent lesser correlation than what it was in earlier times. So these are some explanation that you are seeing. And similarly, again, when you look at monetary policy direction, okay, money growth rate, and then of course the inflation rates of the countries across a reasonable time duration, 2000 to 2010 like. So you can see some countries whose money growth rate is very high. For instance, Turkey had higher inflation rates during this period. Similarly, the Ukraine, Zambia, you probably see the countries whose money growth rate is reasonably low had low interest rates. You can see all the OECD countries are pooled in that low money growth, low inflation trajectory, closer to the 0 point in vertical and horizontal axis, y and x axis of this chart, right? So these are kind of elements that you would see in discussions in monetary and financial market considerations that we are going forward. So this is broadly kind of the direction that we probably be trying to take you through in all this program. And similar lines you probably see we are getting into much more clarity in terms of the concepts that we would be discussing. So I preferably kind of take you through of these concepts and these areas of discussion with greater clarity and details as we move on. But I always appreciate the participation by participants, for that makes the program much more lively in terms of discussions, much more lively in terms of exchanging views and also clarifications, right? So please feel free to kind of communicate if you have any clarifications that you wanted to have in this discussions, and at the same time follow, as I said, the materials in terms of the presentation slides that's been shared with you, and also try to kind of see whether you can have access to the textbook, so that would help you to also get familiar with some of these concepts. But at the same time, please keep a close tab with financial press, financial discussions, monetary policy related discussions, and also try to kind of have an interest in learning some of these concepts, not only targeting your exams, yes, that's a priority. And as I said, throughout the teaching cycle of this with the IBSL, I simply see the number of students who get through this program also very high in comparison to IBSL average. And I believe you all also would continue that trajectory. And this program is very much help you to kind of, increase your own welfare in terms of the understanding of these financial products and the financial markets, while contributing to the overall economic efficiency. So I prefer to stop at this point in our discussion today, simply because that's a good break point for me to kind of start our discussion next Saturday. So you probably have enough time to kind of, go through some of this material amidst all these developments. Probably you must have come out from lockdown and you must be now moving around in terms of your engagement with the employment or other related discussions. And you'll probably be able to see some more discussions going forward. Please prepare yourself to follow up these discussions next week. And if you don't have any questions, I just request you to be kind of, go through these slides, be happy and be safe. Thank you.